The topic is risk analysis. Before I start talking about the subject, I would like to give you some heads up about how I am going to do this and the level of support or the role I'm expecting from you. As all of you know, this is not the O-level, A-level or any other secondary level course. I'm talking to a group of adults, senior executives, and some of you, when I was listening to your profiles, are much senior and have a lot of experience. So, number one, do not consider me as a master or a god and you are below. So, right, I am facilitating a subject that you need to learn or you are not very good at. Probably my knowledge of the subject is little above yours. It doesn't mean that I am above everything. So I expect you to maintain that position and interact with me. Don't feel intimidated. Don't feel threatened. You're free to challenge me. You're free to express your views. You're free to give your comments and make this more interactive. As you can see, this class is a good combination of multidisciplinary people. You are coming from different backgrounds. So you may come with a lot of experience. So sometimes your experience when shared among this crowd can help everyone else to learn out of it. Secondly, there's no question as stupid questions. Because when you are in a learning environment, any question is a valid question, right? So you will not be ridiculed, you will not be exposed because you're asking the question because you want to clarify, because you want to know. Therefore, don't feel bad to ask a stupid question. No question is stupid. You can ask anything, we will clarify. Thirdly, I expect you to attend the class or this course fully because you will realize at the exam, what matters at the exam is not just the note that you have in hand, it's the explanation or the clarification I'm giving that helps you understand the concept, because we are not teaching poems here. We are teaching technical content and concepts. So you need to understand the concept, not remembering the words. So I'm trying to explain in different angles for you to understand what the concept is. So at the exam, what we look at is the application, right? You can learn a subject and then remember it if the question is to state, if the question is to write down the 5 components, right? Write the definition. So that kind of questions, yes, you can read, understand by heart, that's it. But here it's more of application. Therefore, I expect you to understand or comprehend the concept. You're free to ask any number of questions. If you do not get it, I'll try my best to clarify it. And also, I would expect you to bring your own experience. Sometimes it may not be directly relevant here, but let's see how we can connect. And for exam purpose, what is more important is for you to understand the practical points I'm discussing and the tips. So as I move on, I'm giving you some tips, some hints that might be relevant for the exam. That's how I'm going to do. So I'm going to touch only 4 chapters during these 3 sessions, not very complicated. But for some, this is a little alien subject, because I saw only 1 or 2 chartered accountants here, and the rest are coming from different background. I saw even CIMA and ACCA, and others are mostly with part qualifications and more working experience. Right. Any questions, clarifications, or any suggestions that you want to make before I start? And one last thing, don't worry about the language, right? If you think that you want to ask a question in a different language, Sinhala maybe, you are free, right? It's okay. I'm not very good at Tamil, but I'll try to understand. But if you can, if you think that language is a barrier to express your ideas, don't worry about it. You are free to talk in Sinhala. Any clarifications, or are we all good to go? And I'm sure that you all know how to use this raise hand option. Yeah, you know how to use the raise hand option. So there is a, when you go to the what do you call your name, right? You can see this option, right? Raise hand. Because that will help me to interact with you. Then I know sometimes. Let me show you if someone comfortable. Let me show. And if you are not talking to me, can you please put yourself to mute? That will help everyone else. Right. So when you are in the lecture, either you can use the chat box to respond or ask question. Otherwise, you can go to the menu, right? If you go to the menu, there's an item called More at the end of your menu bar. Can you see an item called Reactions? Reactions, right? You go to that Reactions and click. You can see there are icons, right? And there's one icon called Raise Hand. So you can use the Raise Hand option if you want to indicate that you have a question, so that I know somebody has a question. I'll allow that person to talk or raise. Or you can use a chat box. And I'm also interested to know that you are engaged in the class, because I can't see your faces. Whenever I want you to respond, you can use the thumb. You can see thumb option, right? Raise thumb option in the reaction. You can use that so that I know you are responding to me, right? So please use those tools when you are interacting. That will help as a facilitator to know that the participants are with me, because I'm not sure how many of you are lecturers, but you will realize how difficult is it when you talk to a group of people without seeing them, just to the machine, and making sure that they are listening and they understand. So only way for us to know is your response, right? At least you show your thumb and say, okay, yes, I got it. Or you raise your question so that I know you have a problem. So I expect that cooperation from you when we are having in an online session, right? I have a poll just to, I heard your responses, but just to recap a summary of what you all discussed, I'm going to launch a poll. You can select, you can see the options, right? 4 options. I have an accounting degree or professional qualifications. I don't have a degree or professional qualification in accounting, but working in a finance law. I have accounting knowledge, but not working in a finance role. I don't have any accounting qualification and not working in a finance role, right? These are the 4 types I can expect. Let me see how many of you are in each category. I'm launching the poll. You can select. Okay. Select your option. I think you can see the screen, right? You have to just select where you belong.
So what is the second question?
No, don't worry about the second one. It's a mistake. Only answer the first set. Only answer the first set. It's a series of questions. That's why.
So I think we have to select both. Then only we can submit that.
Really?
Yes, sir. Submit button is like it's inactive, so couldn't.
Hold on. I'll end it. Hold on.
Sir, let me know something. Sir,
Yeah.
my business administration, they have accounting part, so I can choose A because I have AD qualification. I'm member of AD.
Okay.
Can't I?
Go ahead. I lost you. I think you're on mute. Hello. I think I lost you. Okay, maybe you can type. Right, I'm relaunching the poll. You can now choose out of the poll. Sorry about the inconvenience. Right. Right, you can choose the options now. Whatever the qualification you have, if you have full qualification in a professional accounting course, you can count it for the first part. "23 people have responded by now. We have altogether 36. "28. We have a few more. "29. I hope everyone can see the screen, the poll. Okay, 30. 31. We have about five more. Right. Anyway, I've got only 31 responses. I'll show the result for you. Right. I'll show the result for you. Right. As you can see, 25 out of 31 belongs to the first category. And we have about 4 people in B. And then I have 2 people on C, and we don't have anyone in the category D. Probably one reason could be that could be an entry qualification for you to have some accounting background, I believe. Anyway, so good. So we have majority in the first category. The reason why I wanted to get it is because this is an important piece of information for me, because then I know the type of people I have to deal with and where to pitch. So I don't need to go to the basics of accounting because most of you are coming from accounting background. But because I have few here who have little out from core accounting, you are free to ask any question if you can't get it. I have another question that is also important. Answer this honestly again. That I need an honest answer for this one. Right, I'll launch the poll again. Right. Because sometimes some people are here, they have some qualifications and they want to add something to their profile for the CV so that it helps you to improve your profile, and it might help you to get your promotions or maybe secure jobs or whatever. Not necessarily to grab, you know. And then there's other group who wants to earn or collect knowledge. When you do B, A automatically happens, but I just want to know where your focus is. Right, 21 people have responded. Let's go fast. Right, 30. Wow, interesting results. I'll stop at this. I got 30 responses. See, you'll be amazed to see this. Very interesting. What do you see? What do you see? 50-50. Right, 50% of the participants wants knowledge. 50% of the participants are here to add a qualification. Okay, that's an interesting statistics again. But I still expect the engagement of the first category, A, because you have invested something. You have invested money, time, and effort. Let's try to get the best out of it. Right, good. So with that, we'll move to the lesson. So today, our lesson is risk analysis. Now, I don't think this slide is in your deck, but just to give a background to this. Now, when we talk about this subject, risk analysis, it is a little complicated topic, but I don't want it to be a complicated thing. We all have a background in financial statements. We know how to prepare financial statement. We know what are there in the financial statements. Whether there are, irrespective of the fact that there are weaknesses in the published financial statement on different fronts, we still believe that the financial statements provide more information, greater clarity. However, when we present financial statements, we pay attention to various aspects. We sometimes go by the accounting standards. We sometimes go by the various statutory requirements. But the point is, whenever you do this, we sometimes present the financial statement based on various requirements. But do we really focus on the needs of the user is one question that we all need to ask when we present financial statements. At the same time, providing information is one. Why do we make information available for the public or whoever through financial statements? The ultimate goal of any reporting, right? Ultimate goal of any reporting is to support a decision. Somebody is waiting to make a decision, and you're there to provide some comfort to the decision maker with the information, so that the decision maker is waiting to get that information to make the decision. So the question is whether we fulfill the requirements of all these decision makers when we produce that information. And if you go back to the decision makers role, decision maker could be sometimes an investor, or it could be some form of a provider of services or finances to an organization and waiting to make a return out of it. In simple terms, we know broadly there are two categories of parties pumping money to the organization in a business. One is the equity holders, the shareholders. The other one is the debt holders. These are the two primary parties who provide finances to the organization. And when you provide that finance to the organization, you have an expectation. What is an expectation? You are expecting a return. You are expecting a return out of it. Right? Equity holders expect dividend plus capital appreciation, and the debt holders expect interest. Those are the primary returns they are expecting. You must also realize that when we expect that return, they also are aware that this return is derived while assuming a certain degree of risk, because returns won't come easily. Every investment option has a risk involved. These risks are categorized into various buckets, right? But in general, what we look at here is when you put some money, you have a risk of losing that money. You have a risk of not earning a return out of that money. Probably you might get the money back in some form, but you might not earn a return out of it. So there is the risk. In simple terms, when we talk about the risk in financial world, we talk about not being able to achieve your return, not being able to meet your expectation. So you take that risk. And today we are talking about globally, all over the world. What is the hot topic now? Can anyone guess? These couple of days, what is the hot topic?
Ocean.
The latest war situation of Russia. because one
Russia.
of Russia and Ukraine.
Last couple of days, you go to social media everywhere.
Yeah, the Titan Ocean.
The submarine of Titan case.
The submarine issue, right? Did you notice that I saw someone has done a research or survey on the Google search. Looks like it's the Sri Lankans who have searched about this the most in the entire world. So we are very keen, and somebody has given a reason for that, because we want to write a lot of stuff. Pata the information known. So people have searched for this. You can see every page, every Facebook account, they are trying to get mileage out of it. They all talk about it. And some are linking it to the religion, some are linking it to various social problems, some are linking it to the faith, this and that, and different kinds of analysis. Now, my point is not that, so that's a little out of the topic, but the reason why I brought that topic into the picture is that, did you notice when you look at this particular scenario that all these people who have gone in that submarine were very rich people, right? I think one has to pay about $250,000 or something, a big amount. So what is the return? What is the return they get out of that? Anyone?
Experience.
Experience. So that return is not necessarily in monetary terms. That return is emotional mostly, right? Emotional, you enjoy. You want to see the ship, the Titanic ship, right? From your own eyes, naked eyes, not from the screen, not from the TV. You want to see for yourself from your naked eyes. You are excited with that experience and you want to get that feeling. So you spend, there's one guy on board in that who has been to space several times, right? With Elon Musk, he has traveled to the space as well. And he has been doing this, right? For several years. He has gone to the deep waters even before. Now, there is a return in some form. What is the risk? What is the risk in that?
Their life at risk, sir.
Yes. There is a probability that you may not come back. It could be a one-way trip. So much so that there is a declaration form that they have to sign before they get into the submarine. The submarine, there is an application form, and there you have to sign that you are willing to take that risk of not being able to come back, so that it's not a surprise for them when they face that situation, because they knew when they go inside that there is a possibility that they may not come back also. So that they put themselves into that situation, they invested in that adventure or the journey, knowing the risk that they are going to take. Right? So what do you call that? When that risk is something that can happen. Risk is something that you may face. It's a negative thing or unfavorable consequence. That is risk. There's a difference between just going in and you know and you go in. For example, let's take a situation where you go on a trip. You go on a trip. When you go on a trip, you want to, sometimes when you see a lake or something, you want to bath, right? So you say, okay, there's a lake, let's go jump and have a bath here. But there are two kinds of people. There is one category, maybe you might find that kind of friends in your groups as well. You just get out of the vehicle, you see water, you want to jump and enjoy. There's another type. Before you jump to the waters, you will search, you talk to people around the area and say, okay, you just check, right? The surrounding, and then when you get some clarity, then you have an idea. And then, okay, you go and check it, and then you know that there are crocodiles in it. Then you have two choices. When you know there are crocodiles in the lake, you can avoid getting into the lake, or you can still jump to the lake. Right? You can still jump to the lake and have that thrill. Let me bath. If the crocodile comes, let me run back. Now, there's a difference between you just jump to the waters without knowing whether there are crocodiles versus when you know there are crocodiles and you jump to the waters. In both cases, you are taking a risk. Right? You have a risk of being a victim. But what's the difference between scenario A and B? Scenario A, you jump to the waters without knowing there are crocodiles. Scenario B, you jump to the waters knowing that there are crocodiles. How you technically explain this? What's the difference in the risk in that case?
So scenario one, what to do not get what to expect. But in scenario two, you get what you exactly expect, probably.
So no surprises. Scenario two, you don't have surprises, right? And also probably you're a little more prepared. Scenario two, you may be a little more prepared, okay? You may be a little more alert, okay? I know that there are crocodiles, let me be alert, right? So I'm prepared to run. So there's a difference, the way you behave in these situations, right? And also in the second instance, you're expecting a crocodile and you keep yourself ready for that. In scenario one, you don't expect a crocodile and you are clueless. And when a crocodile shows up, sometimes you don't know where to run. We have seen situations when people get excited, right? I saw a recent clip in Facebook. There was a lady walking on the road, and by the side there is a telephone tower, right? The pole is there, concrete pole. And this one is shaking and all of a sudden it collapsed and people were shouting. And this lady got excited. Instead of running backwards, she ran forward towards the area the pole was falling. And in fact, it fell on her head. Maybe she died on the spot. Because when you are excited, you don't know what to do. You take hasty decisions, not prepared. So in finance terms, in our technical world, we explain scenario B as taking a calculated risk. What do you mean by that? That means you have an idea about the risk and then you embrace that risk. That's why we say take a calculated risk. So for example, when we talk about the submarine issue, you want to experience that thing, you want to see Titanic, and you go there and they explain, sir, this is a process. And you know that there is a possibility that you will lose your life in this. Do you want to take that risk? And if you are a person who doesn't want to take that risk, you will not go. Then that is beyond my risk appetite. I don't want to take it. Let me stay behind, because I can take a risk. I am willing to take a risk, but not to the extent of losing my life. That's beyond my limit. Let me not go. Or there can be people, okay, yes, there's a possibility that I will lose my life as well, but I know the probability is very little, but still there's a chance. I am willing to take that risk. So it's called taking a calculated risk. And if they don't tell you about that part, that is okay, it's fantastic. Like once in a lifetime experience, you can see the Titanic ship in your naked eyes. Why don't you explore? Then you are hiding the piece of information. You don't give the true picture of the risk to the passenger. And then it's unfair and it's not right. Now, that's the scenario we experienced with Titan. Right? Now, how can I bring that example to the topic we are discussing today? And I told you, we're talking about investors. Investors invest their money. You can be an equity holder or debt holder, expecting a return, and also they are assuming risk in their mind. So they have a perception about the risk that they're taking. Okay, I am investing this money, expecting this return by assuming this level of risk. Although sometimes they may not quantify that, in the back of their mind, they have a understanding, okay, I know that I'm taking a risk. Right? If you get into a jungle, you go wild photography. Although you don't mark it in a piece of paper, in your mind, you are expecting a risk. What is that risk? There may be certain creatures in the jungle, some animals, maybe snakes, whatever, right? I know I'm exposed to that. I need to be careful. But in the back of your mind, you may have certain assessment. Okay, I might get a bear, right, on my way. I might get a deer, right, or snake, but I may not expect a lion. I may not expect a leopard. Because in my assessment, I may have kept them out. So I go to the jungle with that mindset, okay, expecting a bear, expecting. If I knew that there is a possibility of lions being inside the jungle, probably I will not go on that trip. Same goes in investments as well, right? When investors invest money, maybe a debt holder, equity holder, while they expect a return, they sometimes know what they are getting into. Sometimes they assume what they get into. They think, okay, this is a level of risk I'm expecting. And the issue is when they look at the performance of the organization, right? You can be a debt holder, you can be equity holder. Probably the primary source of information for them to understand the performance of an organization is your financial statements and the disclosures you make in your notes and various other things. These people, whoever is expecting that return, can only get an idea about the risk that they face. Risk can be in terms of the leverage of the organization getting into more and more debts, cash flow situations, right? Eventually, the risk of bankruptcy, right? Those are the risks that they are looking at in the organization context, because they want to see whether the organization is a going concern, sustainable, and whether I can get my return. Now the problem is, when we present our financial statement, we follow the accounting standards, we follow various regulatory requirements, are we making sure that we give sufficient information and hints in our financial statements and disclosures for the recipient of this information, that is mostly the investors, to get a fair understanding of the risk? That's the question mark. We provide information, but how far we provide that information in a manner that the recipient of this information can get a reasonable assessment of the risk of the organization. To a certain extent, when we follow the accounting standards and other regulatory requirements, we fulfill them when we present our financial statement. To a certain extent, these parts are covered. But whether that covers to the expected level or the required level is a question mark. And also, that is one side, right? One side is from the provider's point of view. When the information is provided, whoever is providing the information, whether they take care of that. And the other side is from the recipient point of view. You being the investor, are you able to grasp or extract those risk implications from the published financial statements and the notes? And our discussion today, or this chapter, is twofold. First is to understand what type of risk we are talking about and why it is important and how we are getting there. Secondly, the more weight is given from the investor's point of view, from an analyst's point of view, how we analyze and take that risk out, how you comprehend, extract, understand, predict that risk, so that you know the real risk, at least closer to the reality, right, that you are facing than what you probably would have assumed. Is that clear up to now, right? Why we learn this subject, why we learn this topic, the importance of it, and what we are going to do, right? We understand that the investors need to know the risk as much as they expect their return, because their return is extracted in light of the risk that they face. Sometimes let's say I'm expecting a return. You can assume a situation, right? Okay, you want to invest some money. There's one bank saying, I'll give you 15%. There's another bank who will say, I'll give 18%, right? You will not just jump to 18%. You will look at, okay, at what risk I'm going to get that 18%. If I'm not comfortable with the level of risk that I'm going to assume to earn that 18%, I will not go for that 18%. I'll stick to 15% with the level of risk. Therefore, we are now trying to understand how we bring this risk element into the picture in our decisions, and how we extract that risk by looking at the financial statement, because sometimes that piece of information is not obvious. You may have to do certain analysis to take that risk component out of the financials, right? Because it's not given, you extract. That is where you do certain analysis, calculations, all kinds of things. I took a little time to clarify this, because you need to first get the core, why we are doing it, what we are doing it. And then it's easy for us to go to the next levels. Any questions, clarifications up to now? Are we clear on our expectation today? What are we going to do? Any questions? Oh, is that clear?
Clear, sir.
Need a response? Yes, maybe you can type or you can raise your hand or thumbs up, whatever, so that I know it's clear.
Yes, it is clear, sir.
Brilliant. Good. I think some of you have responded. Right. Okay. Now, this table I extract from the recommended book from you. Don't worry. If you don't have, you can take a screenshot or picture. You can see when you talk about risk, right? When you talk about risk, before you get into the details, there are different sources and types of risk that we have to deal with. As you can see, the source can be firm specific. So the nature, I have given details, you can see ability to attract, retain, and motivate employees, dependence on one or few customers, dependence on one or few suppliers, employee relations, litigation, environmental or political scrutiny. Now see, now again you must realize, when you talk about risk, ultimately it is the risk of company or your organization going bankrupt, so that you can't extract anything out of the organization. But as you can see in this example, the nature, you may have the question, how can we find these things in the financial statements? You know, yes, there's a question mark. So you need to realize that all the risks that you can expect from an organization cannot be found in the financial statements alone. There are certain things that we can figure out from the financial statements, but there are things that are outside the financial statements. So to a certain extent, if the organization is producing an integrated report, it covers a wider range of things beyond financial. The finance is just one of the 6 capital we are talking about. Right. As you can see, these things affect your continuity, sustainability of the organization, ability to attract, retain, and motivate employees. Now see, the current context is the best example. See how many organizations losing their best talent these days. People are migrating, right? Migrating, and people have become much more demanding. They demand salary increments. If you don't give, I'm quitting. There's another company waiting to give me 10% more. Demanding. So then, if your organization doesn't have a mechanism to attract, retain, and motivate your employees, that will have an impact on your organization's sustainability. That's a matter of concern. That's a source of risk, right? That fuels your organization's continuity. Dependence on one of your customers. If you have one or two, I know these days, again, if you're an export company, if you're even a company that sells to local market, if you're depending on one or two customers, the moment the customer loses, the moment you lose that customer, that may be the end of your company. I know there are companies who are facing this situation in the current context. Even suppliers, same issue. Employee relations. Employee relations are important to ensure the productivity, because your productivity affects your bottom line. Sometimes people don't understand these things. Organizations, right? Now there was one company, because I told you I'm doing training and all kind of thing. There was one organization who wanted me to come and do a session for their finance team and the sales team. They want to improve their sales, they want to improve their bottom line, and see how you can do that. As a practice, before I get into my core, I just do some background check and discuss with people and understand why you want to do that training program, what do you expect out of it, and what are the reasons. And then I realized this company, having discussed with several people, and in fact, I knew some of these people in this company, and I got some information from internal sources as well. I noted that this company, there's a problem in the production flow, right? They don't get the products on time out for salespeople. And even when you look at the finance side, there's a problem in the cost side. So they are working on a very thin margin. Their cost is heavy. So when I dig deeper, I realized, and I told the management, look here, before you get into the finances or before you get into the sales thing, you must get your house in order. I see there's a problem in your production flow. I see there's a lot of waste in that. I see there's productivity issues. And the root of the cause, when I go further, I noted that they have very poor employee relation. They don't treat the employees well. You know, I got the employees into a room. I said, I want to talk only with the employees, the factory people, workers, not with the without the management. I had 1 hour discussion with them. Earlier at the initial stage, they were reluctant, but later they start exposing. And you know, these employees started crying. And one employee he showed me his leg. He got a wound during the work. He has got a piece of cloth, redipatiyak, ඔතාගෙන ඉන්නේ. Sir, බලන්න මේ ෆැක්ටරියේ හදිස්සියකට තුවාලයක් වුණාම තුවාලයකට දාන්න ප්ලාස්ටරයක් නේ. ෆස්ට් ඒඩ් බොක්ස් එකක් නේ. right? අපිට වතුර බොන්න යන්න ඕන මීටර 100ක් විතර හැපත ටැප් එක තියෙනවා. මේ ෆැක්ටරි එක ළඟ වතුර බන්න තැන. Oh, basic things. So I told the manager, I know the managing director, and I told, look here, I can come and do the training program, but before I do the training program, you have to fix this. These guys don't have a first aid box. They don't have water. Without fixing those basics, how are you expecting them to produce? And how are you expecting them to do productive work? So you must first motivate your people, take care of them, improve productivity, and reduce cost. That's an easy way to increase your bottom line before you go and chase sales. Now see how that kind of things impact your organization. Sometimes that single thing alone, employee relations alone, can lead the company towards bankruptcy. Why? If your cost of products go up, if you don't make gross profit, it will affect your bottom line. It will eventually drain the company down towards bankruptcy. Very simple. So as an investor, it is very important for you to figure out whether the company has those things in place to make sure that those risks are not immersed in the organization. But I don't have time to talk about all aspects. I'm just giving you my, right? Environmental aspects, right? How far you are taking care of environmental things. At some point, it can be a backlash. There are certain organizations, you know, I don't have time to explain, we might know. Some organizations have been closed down due to environmental factors, legal actions against the company, all this. So if the company has not been responsible, problem. Political scrutiny. How are you managing the political wins? That if your company is fully aligned to one political party or alliance or whatever, the moment there is a government change, I know there are certain companies, right? I know there are certain companies who are heavily dependent on government deals, right? Government deals and the tenders or whatever, right? If your exposure is purely on that, the moment your supporting party is no more there, when there's a government change, a political change, that's the end of your business. So these are few aspects that will give you hints about how the organization specific matters contribute to the risk. And I saw there was a message from someone. Let me pull that. We couldn't pay salary at that time because of okay, there's an example being shared. Others also can see. Yes, these are situations. Then industry. The risk can come from the industry. The technology, the competition, regulation, right? Raw material issues, we have this issue even in today's context, right? Import restrictions are affecting the raw material side of the organizations. And labor, right? Labor supply. Today we have that problem also. Labor supply. People are migrating. We have a shortage of skilled people and talented people in the market. So that's a problem in this issue, right? And then as a country, so we are facing the first item very much in this context, right? This is the best time to discuss about it. The country is now in a financial crisis. We are in a recession. That affects the organization. So how far that country situation is affecting your organization, how that risk is going to be materialized. It depends on your dependency on local markets and local resources, right? And even in the current context, some organizations are doing well because some organizations have gone out of the local market. They're in the export market. So the local recession has less impact on them because their revenue streams are safeguarded with that. Likewise, right? Your inflation, interest rate, demographic shift, political environment, I think it's a kind of a rare situation. At present, if you look at Sri Lanka as a country, you have all of these things. We are facing all of them, right? Full package is there in the current context. Now, how it is affecting the organization. And if you go beyond the country, the international market, right? Then the exchange rates, then the respective countries, government situation, political unrest, you know, this geopolitics, right? The Syrian case, right? Russia case, all kinds of things. Now you are facing all of these issues in the international market. You can face. Now you can see the risk for an organization can come from multiple sources. It's good to be aware of where the risk can come, and as an investor, how you get visibility of all these risk elements from different fronts is very important. And in our discussion, we are going to discuss how we are going to figure out this risk. We are not going to get all of these risks, right? We are not going to identify all of these risks by looking at the financial statement. And to a certain extent, some of these risks are inevitable. What do you mean inevitable? That means you are helpless. You cannot do anything. You have to live with that, right? You cannot reduce that risk. You have to deal with it. Even in the current country situation, the recession, the interest rates and various other variables, some of these things we have to deal with it. We can't reduce it, but we have to find alternatives to get away or avoid them, right? So the other part, the risk that we can deal with, we can manage, we need to find ways and means to minimize the impact, right? Minimize the impact of the risk, or keep ourselves away from the danger. So if there is a risk, for example, I'll tell you an example of the labor part, right? Okay, there's a risk of not having adequate labor in the market. Problem. We can deal with it in different ways, right? One thing, how we introduce procedures or techniques or strategies to protect the existing people without them leaving the organization. You lock them up using various techniques so that we reduce that risk of losing people. Another way of tackling that would be you automate, right? You reduce the dependency on humans and you improve the dependency on machines so that you reduce the risk of people-related component. So likewise, we look at how we do those. So the focus of this topic that we are going to discuss today going forward, we are looking at the financial aspect, right? What are the financial consequences of these different types of risk by using the disclosures in the financial statements and reports, right? So we are narrowing down our scope for this particular topic, right? I told you, I explained you the big picture of this topic, but our discussion hereafter is limited to two things. From the risk point of view, we are looking at the financial consequences of the risk that we are going to identify. The second part is we are limiting our discussion to the disclosures in the financial reports. So how we identify these risks by looking at the disclosures of financial reports and then look at the financial consequences. Right. Okay. Is that clear?
Yes,
Are we
sir.
good up to now?
Yes, sir.
Good. Right. Now the time is 9:45. We generally give a little break in the middle, right? 9:30, but I dragged a little bit because we started late and we had a little conversation at the beginning. So because you're at home, because you can have a break while I'm teaching as well, let's not take a long break. We'll take a quick break, but I need to have a quick refreshment. Shall we take about 20 minutes? 20 minutes? Is that okay?
Yes, sir. Okay, sir.
We'll have a 20 minutes break. Now it's 9:50 rather, right? Almost 9:50. We'll get back at 10:10, right? We'll get back at 10:10. Right. Right. I think most of you are back. We'll start. So before the break, I explained to you that in terms of risk, I gave you a introduction. I gave you an introduction as to what the risk is about and why we need to consider the risk, at the sources of risk for an organization. And then I summarized, and finally we came to a point where we discussed the core of this topic. I told you we are going to discuss the financial consequences of risks in an organization. And secondly, I told you we are going to do that by looking at the information available in the financial reporting. Whatever the reported information is used to assess, which means what we are going to do now is just one part of the whole exercise, right? We are only looking at the financial statement related information and get that. But if you really want to do a proper job on an organization, you need to look at things beyond financial statements and bring those things also into the picture. So we talk about financial statement analysis of risks. What are the things that we can extract or get out of this? We talk about financial flexibility. Financial flexibility is the ability to adjust your financial structure depending on the situation so that the organization can continue irrespective of the shocks it gets. Then you have short-term liquidity, right? Then long-term liquidity, credit risk. Credit risk is the creditors are unable to recover their debts and interest. Then we have bankruptcy risk. Bankruptcy risk. Then market equity risk. Then finally, financial reporting manipulation risk. Because as the recipient of information or the investors, they face this risk on top of all other risk factors. If the reporting party or the management of an organization or those who produce the financial statement manipulates the numbers or manipulate the reporting, the recipient will get misled. So there is a risk in that as well, whether the accurate information is present. So all these things we can extract to a certain extent from the financial statement together with other supporting information. So if you move towards the next, you can see, especially out of the three statements, we have the P&L, we have the balance sheet, we have the statement of cash flows. We do not use the terms P&L balance sheet now, because if you can recall in the accounting standards, we have different technical terms, statement of comprehensive income, statement of financial position, etc. But I use the term that we are familiar with, P&L and balance sheet. Now, in terms of risk, it's very interesting phenomenon that we need to understand. Some of you, whoever in the market, whoever has experience would understand what I'm talking. We talk about three statements, right? P&L, balance sheet, and cash flow. Before I get into nitty-gritties, if I ask you, out of the three statements, what is the most important one? Is it P&L, balance sheet, or cash? Can I see your response? You can maybe. Okay, I can do something. Give me a second. I'll quickly launch a poll to see what you have to say. So I'm going to press this. Right, I'm going to launch this poll. You can use the poll. Right, I have, you can answer. Which is the most important or more important? Three people have responded. Let's go past. $26. Right. 26 people have responded. This is the result. 13 says all, 10 says cash flow, 3 says balance sheet, no one for P&L. Okay, why do you say all? Why do you say all? Can someone from the all group say? Mention, or can talk or type?
Because now when we take say the risk, of course, now P&L, it shows basically the performance. But then the financial position, balance sheet basically shows the financial position, and then the cash flow, basically whatever the cash flows, based on that we should be able to predict and so predict the future performance. So in that case, now we need to not only focus short term, but we need to focus long term as well. So merely focusing on one particular statement will not work, because we have to analyze all three to ascertain the company risk.
Why is it that we have to focus on all three? What's the problem? Why can't we limit to one?
Because now if you take P&L, basically it shows only the performance, profit, basically profit, what we can manipulate basically. So whatever the based on the manipulated figure, I'm not saying that all the statements are manipulated, but to some extent basically say like valuation, no stock valuation, no revaluations in that way based on the company policy, accounting policies. Some extent profit can be manipulated. So based on that, if we take a decision, it might go wrong. But cash is the actual position. So a company which makes profit doesn't mean that it is a good company to invest, because if they don't have adequate cash flows or the liquidity, then that is a problem.
Right. Thank you. Any other views? Are we all in agreement with her explanation? If others agree, you can type yes. If you have different views, you can explain. Okay.
I think some most of information can be taken through the balance sheet, because when we are referring the P&L, we can show that we can take the result of the performance. But when we are comparing comparative figures of balance sheet, we can take P&L information also. In addition to that, we can take the cash flow summary throughout the balance sheet with comparing previous year. So I think the most important one is balance sheet, because
Balance sheet.
overall assets level, liability, each and every component of the financial statement can be reviewed throughout the balance sheet.
Okay, because it captures everything eventually. Okay. Okay, good.
Yes.
Right, thank you. Any other views? Any other views? Okay. Right. Yeah, we can argue differently depending on how you want to prove your case. Now, one thing we need to understand is that these P&L, balance sheet, and cash flow, they are statements that captures different aspects of the organization. If I rephrase my previous question, without talking about the financial statement, okay, I'm going to give you a different poll now. Okay, let's see how you respond to this one. Right. Right. I'm trying to prove a point here. Right. What's your answer to this one? You can see the poll. What is more important? Quickly, let's answer. Right. So I got 25, okay, 26. Earlier also I had 26. Okay. Here's the result. This time I get more, except 2 people. Almost everyone says more. Why? Why all? Why did you pick one? Eyes, nose, mouth. Why did you pick one? Okay, somebody has picked eyes. Why did you pick eyes? Those who picked eyes, can you tell why you picked eyes? Quickly, you can type if you want. Can't hear. Someone from the other group? All? By all?
I'll give my answer to all, but when I thinking more and more, I thought that's mouth, because without eyes people are living, and without nose I think we can somewhat survive, but without mouth we can't eat and talk, and I think
Without mouth,
more-
females can't survive. Without mouth, everyone can survive.
we can't eat, talk. I think mouth is more important to survive.
I think the similar logic must have been there with eyes. Somebody has picked eyes. But majority is for all. That's one reason. That's one reason why you pick all. I'm trying to get that reason. That's one reason why you pick all. Just think about it. Why did you pick one? Why we? Yeah. What's the reason? We'll go fast.
So we need to get a clear picture of everything what we are experiencing and what we are going to do. So that we need eyes and mouth and nose. Because we need to smell something. Eyes need to get a clear picture, and mouth need to get some.
So what does it
food
mean?
and-
Technically, what does it mean? It means they are not substitute. They are substitutes, right? You can't do what you do with eyes with your mouth. You can't replace one for the other because they do a different role. Each part has a role, but eyes can do, your mouth can't do. So if you want to survive, if you want to have a proper functioning as a human, you need all of them because you can't replace one for the other. You need to wear the same hat when you look at the financial statements. That's the reason why I put it, because sometimes you forget it. When you use financial statement, they are not substitute to each other. What P&L can does, balance sheet cannot. What balance sheet does, cash flow cannot. Because they are three different statements looking at three different aspects of the organization. You can't say one is better than the other. But one can stand out the rest in a given situation. When you go and watch a movie, you don't need a mouth. Your eyes and ears would do the job. When you eat, you don't need even eyes, right? If you can move your hand to mouth, you can do, right? Even someone can feed you, you can eat. So depending on the situation, the priority changes. The importance of one will change over the other. But overall, you can't say one is better than the other. Same goes with the financial statements. When you look at the financial statements, when you look at different aspects, right? You look at different aspects. Performance, P&L. Position, balance sheet. Cash management, cash flow. Right? When we look at the sustainability of an organization, what is more important for a sustainable organization? Is it profits or cash? To continue, do you find companies with profits and no cash continuing business? Or you find companies with no profit but cash continuing business? which is common, which is feasible. Fast. Cash or profit? Which company can continue? Company with cash, no profit. Company with profit, no cash. Which company can continue? Yeah, both are important, absolutely. But for you to continue the business, what is more important? Let's say you have cash but no profit. Can you? Yes. Of course, profit is important to generate an excess in the business. Otherwise, you can't sustain. But the problem is, even if you have profits, if you don't have cash, you can't continue. So the lifeblood of an organization, the continuity of an organization is heavily dependent on the availability of liquidity, that is cash, right? There can be profitable companies with no cash, you can't continue. You need to get some funding from a bank or somewhere, right? But that's even when you're in a crisis, especially we can witness that. The companies which had good profits can't continue in the current context because some of these companies have taken a lot of loans, you have commitments, you have profits, but your cash flow is not adequate to meet the obligations, then you can't continue. So when you look at the bankruptcy of an organization, right, one of the fundamental focus areas is your cash. That's why when you analyze the risk of an organization, apart from other things, it is very important to ensure that the company's cash management is good. That is why historically most of the local businesses survived, because they didn't have this sophisticated ERPs or any other stuff. Most of these business owners, they keep a close eye on their cash flow. That's how they survived. They know where the money is going there, they know where the money is coming. But in the current context, most of the organizations don't know what's happening to their cash. They manage the numbers, they look at the profits, they look at the P&L, they look at the performance, they look at the indicators, all kinds of other things, but they don't have proper track of their cash flow. So they only realize that the cash flow is not working in the right way when they get stuck, when they can't pay their salary, when they can't meet their debt obligation. When they get stuck with cash, they realize what has happened to the cash. Still, they don't know what has happened to the cash. They only know there's a problem with cash. That's why when you look at the risk analysis, we have to pay a greater attention on this part. In the cash flow statement, you can remember, we break that into three broader buckets: operating activities, investing activities, and financing activities, right? Operating activities, investing activities, and financing activities. So in these three areas, we look at different aspects. Your core business is captured in the operations. Then investing, you know, it's acquisition and disposal of fixed assets and investments, other investments. Financing is about funding and liquidating, right? So you take borrowing or settle a borrow. So either way. So these three aspects will tell you what happens. So the first one, the operations cash flow from operating activities, is your day-to-day business. How far you are managing your short-term liquidity. The other two mostly contribute to the long-term, the solvency part, long-term ability of generating cash and maintaining it. So it's very important in today's context, right? Even when I work with a lot of entrepreneurs, businesses, SMEs, they come with their problems. They come with their issues. So one of the fundamental things I do when they come, more than anything, I want to look at their cash flow. I'm getting the cash flow forecast. I'm understanding what has happened to the cash. At least if they don't have, I'm getting their bank statements, cash book. That's the beginning point. Everything else is secondary. If the company has not managed the cash well, Everything else, no point in looking after, because you can fix everything. You can get the best talent to the organization. You can get the best formula. You can get the best manufacturing facility. You can get a good customer. You can get everything. But if you don't manage your cash, you cannot survive. Right? That's a very important point. Right. And interestingly, I see in certain I think this is a lesson for all of you here, whoever are CFOs or the heads of finance in this group. I sometimes see in organizations, you allocate different tasks to different people, right? You have the head of finance or the CFO, and then you have the guy to look at the reconciliation, guy to prepare the financials, and guy to look at payments, a guy to look at cash and bank with the bank matters and all that. You give bits and pieces. But sometimes I see the CFO or the head of finance do not keep a close eye on cash. Right? You hand it over to a guy below you to manage it, but you don't keep it up. This treasury management part, cash management part is now a fundamental function of a CFO. It might sound operational, but it is key. So you need to, at your level, get involved in managing cash, even if you have delegated it to someone else. Because however much you manage the rest, if you don't manage your cash, you cannot run the business. Very simple. Right. So when you look at the financial flexibility, I told you, right? Financial flexibility. Here, we are looking at how the organizations can manage your financial landscape. So here we are mainly looking at you managing your financial structure. And this is an important piece of discussion because this goes a little further than what we look at generally. The fundamental thing about managing finances, right? You get funds into the business. Either you take from equity or you borrow, right? It has a cost. That is called cost of funds. Equity, there's a cost. Debt, there's a cost. So if you look at debt, that is a direct and obvious cost because there's an interest, predetermined interest component. When the bank lends, they say, okay, 10%. So the cost of funds is there. The fundamental principle in managing finances is that you need to make sure your return on investment, that is, whatever the return you are going to extract after deploying that funds, that return should be greater than cost of funds. Very simple. If you borrow at 10%, you should be able to generate a return more than 10%. That is the fundamental principle of managing finances if you want to borrow funds. Otherwise, you're only burdening your bottom line, because if you borrow at 10% and if you generate 8% in return, you are losing 2%. There's no point in borrowing that money and doing that business because you are anyway losing. So keeping that at the back of your mind in terms of managing finances, there's another point to deliberate, that is how far the organizations can benefit from leverage. Leverage means getting more debts. Let's say you have 500,000 capital in the business. You need more money to come in, another 500,000. Now the question is whether you should go for a debt or equity. Now the theories suggest, based on empirical evidence, the organizations can benefit more, or the return can be more if you have more debts, right? So that is due to several reasons. One of the fundamental reasons is the tax advantage, because interest cost is tax deductible. Therefore, your ultimate cost, you are getting a tax saving there. That's one side. The other component is, if you look at from equity holder point of view, if you get more return, and if you have acquired that funds through equity, you are broad basing your capital. That means whatever the return now has to be allocated or divided among larger group of people, then your individual return might come down because your base has increased. But if you borrow money and expand your business, your equity base remains the same. So in that case, whatever the return entirely will go to the existing pool of equity holders. So in that case, again, it's beneficial to go for debt than equity because the shareholders' return will increase. However, that is the return side. But there's another side to the story. When you increase your debt, you're increasing your risk, your financial risk. Why do you increase your financial risk when you increase your debt? In what sense? Why we say so? Can anyone tell me? Why we increase our risk when we have more debts? You can type. Why we increase? Okay, there's one answer. Yeah. Need to pay back. So when you have debts coming into the picture, you're adding a permanent commitment. When you say permanent, it's not forever, but until over the period of your debt. That's a permanent commitment. That means irrespective of your profits, you are committed to settle the debts, capital plus interest. So you are committing your cash flows. If you are unable to generate that profit, you are still liable to pay. So as a result, your cash flow, whatever you generate through your profits, will have to be transferred to debt. Another thing is your profitability will not remain the same, right? It might fluctuate with your cost base, market price, and etc. Then your debt interest is locked. If you have interest of 10%, you have blocked it. Your profitability can be 8%, 6%, 10% up and down. So you are again locking your commitments. As a result, that restricts your cash flow, and that can even dry out your cash flows. As a result, the company may face working capital issues and eventually liquidity, and then you have a solvency issue, and the shareholders may end up not getting any dividend or any return because they are blocking everything to the debts. So as a result, on one side, we say having a greater leverage increases our return. From an organizational point of view, it increases return, it's good. But from a risk perspective, it also increases the risk. So high risk, high return option. Now, the slide next is a little technical, but I'll explain you what it means. This particular formula, you don't have to worry about the calculation. Don't try to understand the calculation and all that. Just get the logic here. What they're trying to do is return on capital employed. When you say return on capital employed, that includes the overall return from both debt and equity. So we are decomposing it. That means we are splitting it and saying operating ROA plus leverage into spread. Right, spread is your return on assets minus cost of debts, that excess. So what this says is, in simple terms, this formula, what it's trying to prove is, when you decompose your total return into debt and equity, your return is greater when you have more debts. That's the bottom line this tries to prove. Right? I will not waste time in calculating things and getting the numbers. All what we need to understand is when the organization increases the leverage or the debt, it also improves the ability to generate more cash. That means the return will go up. And at the same time, you are increasing the financial risk as well. Right. So how it links to the flexibility? Because when your finances get stuck, when your return is reduced, then you lose your margin to play. Right? You can't switch, you can't play because your cushion is limited. But when you have a greater cushion, you can play because you have option. You can afford to have shocks because you have a greater margin. So then when you go to the next one, short-term liquidity risk. That is very simple. That is the working capital part. Whether you have the ability to meet your routine working capital needs. So how it can get disturbed? One is when you have your cash flows, that's why we always say, especially in the current context, when you have a tight cash flow situation, you need to be very clear about where the money is coming from and where the money is going. If you don't have a close track of that, the formula can go other way around. Say you have overlooked a cash outflow situation, and you did not prepare yourself with sufficient funds from the inflow side, you get stuck. Therefore, you need to now plan and time your cash flows. Exactly when I'm going to release this cash, exactly when I'm going to collect this cash. Then how are you going to match it? That's very important. Otherwise, you can get stuck in the middle because you have an outflow, but your inflow is not ready. Then you have another problem, high degree of long-term leverage. That means if you have more long-term debts, that also impacts your short-term liquidity. Why? Although the debt is long-term, you are supposed to pay the installment on a continuous basis. So if you have higher long-term debt, higher installments, right? So therefore, that long-term debt also has short-term implication in managing your cash, right? So these indicates risk, right? When you look at the balance sheet of a company, if you see your working capital is poor, your current assets, current liabilities, you can analyze, it's poor. That will indicate short-term liquidation. And also if your organization has heavily leveraged, right? That means it has more long-term debts. If you look at the debt equity, very high, you can see it can cause a problem. So these are some of the ratios we use. I think these are not difficult. We are familiar with this, right? Current ratio. Current ratio, what does it mean? When you calculate the ratio, if the answer is 1:2, the answer is for 1 rupee of commitment, you have 2 rupees at hand. That's the idea. That means your asset side is double your liability. That gives you a feeling or the cushion available to meet the gap. So that gives the comfort for the reader, right? Then we also have what we call quick ratio or the acid test ratio. There, what we do is we take the inventory out, right? We keeping the inventory apart. We try to see where are we. Now, tell me, this is an interesting question I sometimes ask. Tell me why we eliminate inventory when we calculate the quick ratio.
That is because now inventory, when it compared to other like cash, the liquidity is low. That is when we try to convert it to cash, we might have to incur significant financial loss. So because of that, since the liquidity is low, we remove that in arriving at asset test ratio.
I can see another response to message, the same thing. And that's the same answer I'm getting from most of the accounting people when I ask this question. So the logic is, it takes time to convert to cash. Right? If I follow that logic, I have another question, counter question there. Let's take debtors. Debtors, sometimes we give 30 days credit, maybe even more. So if you have 30 days credit cycle, so it takes 30 days to convert, right? Now, if you have a bakery, right? You say you have a bakery with credit sales, 30 days credit. How long can you keep a bread or bun? 1 month? I don't think, right? Maybe a couple of days sometimes, maybe one or little more than 1 week if it's bread. So if I go by that logic, I know that my stock is moving faster than debtors, because debtors, it will take 30 days minimum. My inventory is moving very fast. So if I apply the same logic here, can I then, when I calculate the quick ratio for that bakery, can I remove inventory and keep, sorry, can I remove debtors and keep inventory in the formula? Because in that case, the debtors take longer than inventory. How do you respond to that? Any questions, any answers? I think this is where most of the people get stuck when I ask this question for the previous answer, because that's no harm, because that's the answer we get from many accounting people. But the real catch is here. Then it requires you to think again, is timing the real reason why we take inventory out? It may be true for things like, fixed assets, some furniture, or maybe some items, durable items, maybe yes, it might take time, then that's a difference too. So from a liquidity point of view, the real reason behind taking inventory out when we calculate quick ratio is not the timing. It is the fact that there's no guarantee your inventory will convert to cash. What's the guarantee? Do you have a legal entitlement, or have you established the right to convert to cash? Debtors, yes. Even late, right? Debtors, there is a right to convert to cash. You can enforce legally or whatever the way, you have the right. You have established the right to convert to cash. But inventory, until you sell, you have no guarantee that it will convert. Even the bakery issue, I can have breads, right? Bread can get sold faster, right? We have to sell it within 1 week or whatever. But there's no guarantee that I will sell all the bread. Right? What if the government make bread illegal? There's a gazette. From tomorrow, you can't sell bread in Sri Lanka. What happens to all your bread? You can't sell. So the real reason is inventory, you are yet to establish the convertibility. You are yet to establish the right to receive cash. Therefore, until the sale is confirmed, you can't say it's money. That's why you take it out. Even if we can't sell the inventory, right? By any chance, if we can't move this inventory out, are we safe? And that is the situation most of the companies facing now. Yeah. In the current context, a lot of the companies can't move their inventory. It's stuck. Then current ratio has no meaning in that context, because current ratio can be jacked up with the inventory, but it has no meaning if your inventory is not moving. That's why the quick ratio is more relevant in that case, because that gives you the real situation with cash. Again, if you go by this logic, right? See, there's something that you need to understand when you manage finances or anything in organizational context. You have to challenge the textbook, right? Right? You have to challenge the textbooks when you manage real life. There is a definition for current ratio. There's a definition for quick ratio. Yes, that is given as a guidance for you to calculate the ratios. But you need to understand the logic behind those calculations and whether it makes sense. Because you are trying to take a decision out of these ratios, not just to impress someone that I have a higher ratio or lower ratio. That's for exams. That's for exams. But when you manage things in real life, you need to play around with some of these concepts. Say, for example, if you go by the logic that I just mentioned, when you calculate the quick ratio, you may even take a certain portion of your debtors out. You know, I have debtors, that's in all these debtors, right? You know, there's something called permanent debts. I'll show you. You can see the screen, right? If you look at the debts, right? Debtors, your debtors balance can fluctuate time to time like this. But you see, over the period, there is a component that will continue, right? Non-moving. So if my debtors is 50, there's about 20. I always carry this, non-moving. So if I am to calculate the asset ratio, quick ratio for my business to manage efficiently and take decision, I would consider even this 20 as permanent. I take it out. For my calculation, I will only consider 30 as my debtors, because this is the one that gets converted into cash. You follow? Then that is very important. So this is master's level, right? I don't know, for whatever the reason, I'm not expecting people to stick to the textbooks if you want to really manage your business, right? You have to challenge. These are all guidance. Some of these things are, you know this, what we call under lab environment, right? So some are controlled, some are with a lot of assumptions, right? Some are for certain conditions. So some of these concepts are relevant only for manufacturing companies. Some are not relevant for service industries. And some of these things are relevant for a given business model. And if your business model is different, some of these concepts are not important or not relevant in your business. So you should be able to align your formula, align your theory to suit your business when you manage your business. Otherwise, you get a standard technical theoretical answer that might not give the true picture of your business. Then you can't manage this that way. Right? I hope you get what I'm saying. It's very important. Right? Some of these textbook things are good for you to pass exams. But when you are in the real world, that is one of the reasons why sometimes most of the learning we have in our school or professional courses or maybe in the university become irrelevant, or we don't use them when we go and work in the organization, because you can't connect the two. Because some of these models or the theory doesn't go very well with your practical situation. But the worst thing is, because we have learned that model and theory, because we think that is the ultimate truth and the framework, most of us try to fill, right, the template. So in the interest of time, let me close this thing. Right. So most of us, what happens is, we try to get a theoretical model or a framework or a template, and we try to fix our business into the template and see how, okay, this template has 4 quadrants. Let me try to park all my business stuff in this 4 quadrants, because that is what is there in the textbook. But if you really look at your business, you can't put that business into these 4 quadrants. Your business is different. Probably you need an adjustment in the model to suit your business. But unfortunately, most of us who are qualified, who have degrees, are reluctant to challenge the model. Instead, you try to fix the business in the model. But I would suggest you first look at the business. Model is just an enabler or a tool or a support that will help to manage your business. Then you first see how far this model is going to help me, how far this model is compatible with my model business or the situation. And then if there's a gap, see whether there is a requirement for you to modify the model and then align it with the business and solve the business problem. So most of the time, I have situations where I blast people, even my own subordinates, when they come up with that kind of solutions, because you can't solve all our real life problems with textbooks models. So in my course, I don't know about the rest of the papers. In my paper, I consider you all as senior people who are practicing things, living in business world, dealing with day-to-day issues. So I expect you to have that mindset, not to just accept any model as it is, but to challenge it. And eventually your job is to make use of the model to solve your problem, not to alter your problem to fit the model and then not solving your problem. No. I might have given you something that you don't expect outside the traditional way of getting the feed, but that is how I work. Because one other thing, in this course, I am supposed to be an industry expert. I'm coming from the industry to bring that practical flavor to the course. So if I also go and read out of a book, then I don't serve my purpose. That's why I want to challenge it, and I want you also to do the same. Right. I could not complete the presentation today. That's fine, because we spent a lot of time at the beginning getting to know each other and setting the stage. And for some of you, you are seeing me for the first time. Therefore, there is a familiarity gap as well. Therefore, I didn't want to rush. But next day we are meeting. So I will complete the balance part of this lecture. And also, I'll start the next topic. So within the given period of time, I will complete the entire allocated syllabus for me. Right. Any questions, clarifications, comments, anything, even critics, what you have? No questions? So are we good with what we discussed? Is that clear?
Sir, this is just to get your opinion on this.
Sure.
Now, this is little away from what we studied, but then now because of the current situation, like as you said, cash is more important, and then basically cash is the king basically now. As you said, sir, because that is more important. So in that case, now, what do you think? Because of the current Sri Lankan context now, like if you try to invest, either you are taxed or the rates have come down. So bit difficult to take a call as to what to do with the funds effectively. So in that case, what do you think, or what do you advise us? Because now, if you keep it in the bank, no point. And like if you put it in the FD, rates are very low. But meanwhile, the taxed at the higher rate of 30%. But then, so what do you think, or what is your advice, sir, with regards to managing the fund, the cash effectively, apart from the funds that we keep it for operational purpose?
Very good question. And that is a common question everywhere as well. The first thing is that we need to understand the context. Number one, because if we think that we still live in the old days that we lived in, we will never get through this. First, understand the context, understand it is different to what we have faced in the past, and also understand we are facing multiple uncertainties from many fronts. So almost everything is gray, right? You can't predict even tomorrow. So when you have such a greater degree of uncertainty, unpredictability in the environment, you have to use techniques to deal with it. So it has two sides. One thing is you must use more and more contemporary tools to deal with the uncertainties. When you have uncertainty, the best way to deal with it is have more scenarios. Right? Scenario plan. You have to be good, especially the finance people have to be good at scenario planning. You have to look at what are the alternative futures you are expecting. Right? The government is talking something, IMF is saying something, market is behaving in a particular way. We must also take everyone's statement with a pinch of salt, which means everyone is talking from their point of view to defend their position. The government is talking from their point of view to defend the government position. Central bank will talk from their point of view. Opposition will talk from their point of view. But we being professionals must be impartial and see what is the theoretical fundamental way things can happen. Say, for example, when the government say, okay, we are trying to bring down the exchange rate within next 3 months to 250 or something, you have to use your technical hat and see how feasible is that, right? Is it just a political statement? So getting the context right is very important, keeping out all these biased statements and opinions of people, right? We have to be thorough and we have to take that view first, because I sometimes see even professionals taking political views. That is very bad, right? Because you are supporting a particular viewpoint, maybe you are a supporter of the government, then you are a professional and you try to interpret your case in support of the government. And if you are not supporting the government, you do the other way. So we as professionals must be impartial. So then take an impartial look at the future. That's number one. Then the scenario planning, I told you, we have to be good at scenario planning and see what are the alternative futures we are dealt with. And each of these has opportunities and threats. And also we have to understand the risk of each alternative. Thirdly, we also need to build certain skills within us as individuals and as organizations. The very first point we discussed about the flexibility. So I call it agility. So we have to have an organizational context where we can respond fast to situations. If you stick to something, you can't. Especially, this is where especially large organizations need to revisit their bureaucracies and protocols. If your approval process takes too long, you can't respond to the certain changes in the market. Right? Say, for the finance guy to take a decision, you have to put a paper, it goes to the management committee, and it goes to the CEO, it goes to the subcommittees, go to the board. It takes 2 weeks to get the approval done. By the time your proposed action is out of date, because the scenario has changed. So you need to now introduce certain fast track decision-making processes in the organizations. That's one side. On the other side, you also need to improve the skills of people, your decision makers, how to make decisions in uncertain situations, how to take decisions with limited information, how to make decisions without complete information. Because most of us are very comfortable making decisions with complete information, but you never get that. Because even if you get complete information today, by the time you make decisions, the information might have changed. So you have to absolutely, and you have to have a very good market intelligence unit in your organizations. At least the finance guys need to be doing that role to feed the decision makers with the latest relevant, reliable information for decision making. Your market research has to be very strong in the current context, because the winners are the people who predict the market more accurate than the rest, right? So if you know what's going to happen, so like for example, let's say the dollar rate, right? If what happened recently, people were panicking, right? When the rate comes down from 350 to 300 something, people go, okay, it will go further down to 50, people start dumping their dollar. Now it doesn't go beyond that. So if you need more access in the market, if you have more market information, you might act faster and better than the rest. So no, I know that I didn't give you a specific answer because there's no specific answer to this question. So what you have to do is you have to build those capacities, competencies, and structures in the organization to face this reality. If you do that, I won't say you will get what you want, but at least in the current context, I always advocate you should not look at the positive. You must try to prevent the damage, right? You try to prevent the bleeding, prevent the damage, prevent the disaster. Then you can be a winner in the current context, because we are in a survival mode, not on a growth mode. So in that case, we also need to keep in mind that don't keep all your eggs in one basket theory, right? However much profitable the proposition you get, don't put everything there, right? Yes, always risk. You have to, that's where the finance needs to come into the picture, and you need to demarcate your funds. You need to demarcate your risk. So you, okay, we'll put something in a fixed deposit, to save something. Okay, we put something here. You have to do that. So your finance guy has to be very strong in the current context to, drive the discussions and convince your rest of the decision makers in the organization, because your argument should be backed by facts when others throw opinion. I know I gave a very comprehensive but fast answer. That what you want is inside my explanation.
Yes, sir. Thanks. I got it. Meanwhile, like now, when, as you said, sir, when we do some scenario plannings, also like we'll say because of the current situation, like to some extent, we will have to take the risk also. For, as you said, sir, this example with regards to exchange rate. Now, whether to convert the dollars. Now, are we keeping the dollar funds or not? It's a problem actually. In case if the rate goes further down, we'll be at a loss. So in that case, it's if we do another option for that, or if we have another alternative plan, still at that point also we have to take certain amount of risk, because don't know what will be the exact future situation.
Yeah, that's why I told you at the beginning also, we have to take calculated risk, right? When we take a decision, everyone in the decision making forum need to be aware, okay, this is what it is. Now we have looked at the market situation. We are going to convert our dollars at this point in time, right? Sometimes there's a possibility it can go up tomorrow. We take that risk, but let's agree, take the decision. We'll face the consequences later. But later someone can't come and say, look here, if we knew that the rate would go up, we wouldn't have done that. This and those are silly arguments. You can't come back again. That's why it's very important at the decision making point, you lay down the situation. Okay, this is the decision we are taking. This is the risk that we are taking. If the risk materializes, we might end up having this kind of a loss or whatever. So let's bite it. Right? Otherwise, you can't speculate all the time and postpone the decision. So you need to set the purpose, right? Why you make that? Why you want to convert the dollars? Are you trying to gain out of your dollars, or are you trying to meet your cash flow need? Two things. Right? If you need some rupees, you need 100,000 rupees, you have some dollars, so you convert the dollars to fulfill that 100,000 rupee requirement. That's one thing. That's a cash flow requirement. Another argument is, okay, now the roll rate is moving. Let's try to avoid losses. Let's convert 200,000, right? So that we avoid the losses. But tomorrow, once you do the conversion, the rate goes other way around. You took a bad decision. So that's a different story. You have to understand why you take that, and then everyone needs to agree on it. Move forward. Otherwise, if you keep on beating the decisions or the regretting on what we have done, you never move on. Not only with the organizational context, same goes with your real life as well.
Yes, sir. I got it, sir. Thank you, sir. Thank you so much.
No problem. Good. Any other? Right. So maybe I'll see your faces next day when I meet. Until then, thank you for staying. We'll meet up the next day. We'll first finish the balance part of this topic and then we go to the next one. Bye.
Thank you, sir. Thank you.
Thank you, sir.
Thank you, sir. Thank you, sir.